Hi! My recent video introduced you to the world of group accounts and consolidation, and just in case you missed it, you can find it right in this channel or on my website. Today, we'll take a look specifically at the first standard dealing with group accounts. This is Sylvia of IFRS Box, and you're about to watch the short summary of standard IFRS 10 consolidated financial statements. If you'd like to learn more about the consolidation and actually learn how to do it, then you're welcome to check out my website, ifrsbox.com, together with my courses, IFRS quizzes, and many more. Before we dive in IFRS 10, let me briefly tell you how it developed over time and what the current status is. In 2001, the standard IAS 27, titled Consolidated Financial Statements and Accounting for Investment in Subsidiaries, was issued. And just 2 years later, in 2003, IAS 27 was amended and renamed to IAS 27 Separate and Consolidated Financial Statements. So then IAS 27 gave rules about accounting for investment in individual investors' accounts and about preparing consolidated financial statements too. Well, then some years passed, there were some amendments, and in 2011, International Accounting Standards Board decided about a major change. In fact, the standard IAS 27 split, and as a result, IAS 27 was renamed to Separate Financial Statements, so it still applies, but no longer contains the rules for making consolidated financial statements, just for the separate individual investors' accounts. The new standard, IFRS 10, was issued with the rules for the consolidated financial statements, and also disclosure requirements in IAS 27 were replaced by the new standard IFRS 12. Well, but that's another story and we'll leave it out for now. In 2012, IFRS 10 was amended and several amendments were added. Probably the investment entities are the biggest one. And as a result, IFRS 10 applies for all periods starting on or after 1st January 2013, and the rules about investment entities apply 1 year later, so for the period starting on or after 1st January 2014. The objective of IFRS 10 is to establish principles for the presentation and preparation of consolidated financial statements when an entity controls one or more other entities. And in order to meet this objective, IFRS 10 requires an entity or the parent that controls one or more other entities or subsidiaries to present consolidated financial statements. And if you'd like to know the definitions, please check out the video Introduction to Consolidation and Group Accounts. IFRS 10 also defines the principle of control and says the whole guidance about the existence of a control. And also it explicitly says that when an investor controls an investee, it must consolidate. Well, with some exceptions, of course. IFRS 10 also sets out the accounting requirements for the preparation of consolidated financial statements and outlines the procedures you need to follow. And finally, IFRS 10 defines an investment entity and sets out an exception to consolidating particular subsidiaries of an investment entity. Let's take a look at control first. An investor controls an investee when it is exposed to or has rights to variable returns from its involvement with the investee, which will be a subsidiary in this case, and has the ability to affect those returns through its power over the investee. The focus here is on power, and IFRS 10 defines it as the existing rights that give the current ability to direct the relevant activities of the investee. Well, relevant activities are those that substantively affect the investee's return and may include, for example, purchasing decisions, research and development, etc. The existing rights must be substantive, so the holder must have the practical ability to exercise that right. And the investor must have a current ability to exercise these rights, not some potential ability in the future. IFRS 10 suggests that more than one factor need to be considered, and also there's a whole guidance in IFRS 10 about the control, its existence and non-existence under various circumstances. And if you'd like to learn more, please check out the IFRS Kit course in my website. Except for the control, IFRS 10 speaks about the consolidated financial statements that are defined as the financial statements of a group presented as those of a single economic entity. So basically, we take the separate financial statements of a parent, then the separate financial statements of a subsidiary, and based on these financial statements, we can make a group consolidated financial statements. And it means that you need to perform certain consolidation procedures because it's not a simple addition of two numbers. All these procedures are prescribed by IFRS 10, and except for these procedures, IFRS 10 sets the accounting requirements that you must apply when making consolidated financial statements. For example, about uniform accounting policies, different reporting dates of a parent and subsidiary, inclusion and exclusion of a subsidiary from consolidation, presentation of non-controlling interests, changes in ownership interests, and other. Let me briefly describe the consolidation procedures required by IFRS 10. Step number 1, combine like items of assets, liabilities, equity, income, expenses, and cash flows of the parent with those of its subsidiaries. Combine means simply add up. Step number 2, we need to offset or eliminate carrying amount of parent's investment in subsidiary with parent's portion of equity of each subsidiary. Step number 3, offset or eliminate in full intragroup assets, liabilities, equity, income, expenses, and cash flows relating to transactions between companies in the group, because from the point of view of external users to the group, there's no transaction. Finally, let me brief you about IFRS 10 exception related to investment entities. IFRS 10 sets several exceptions or parents who do not need to present consolidated financial statements, and investment entities are one of them. This one is very significant and it must be applied for the period starting 1st January 2014, so it's already in place. And it really affected lots of companies, mainly the investment funds, because they needed to prepare consolidated financial statements before this exception came into effect. So what is an investment entity? It's an entity that obtains funds or money from one or more investors for the purpose of providing those investors with investment management services. Its business purpose is to invest funds solely for returns from capital appreciation, investment income, or both. And it measures and evaluates the performance of substantially all of its investments on a fair value basis. IFRS 10 provides a guidance how to determine whether the entity is an investment entity or not, so you might need to check it in the specific circumstances. But the main 4 characteristics that the company is an investment entity are: it has more than one investment. Then investment entity might have more than one investor. That's not the condition, just the characteristics. Also, it has investors that are not the related parties of an entity, well, other than having direct shares there. And finally, it has ownership interests in the form of equity or similar interests like shares and not debt. These are just characteristics or indicators, and even if the opposite is true, the entities can still be classified as an investment entity. So you must assess each case individually. So this was the short summary of the standard IFRS 10 consolidated financial statements. If you're interested in more detailed explanation of the group accounting or our case studies and examples teaching you how to prepare consolidated financial statements, please check out our IFRS kit or subscribe for the free weekly newsletter at ifrsbox.com. Bye-bye and thank you for watching.